So for the next 10 minutes or so, I'm just going to talk us through the fiscal challenges the energy transition poses to oil and gas exporting countries, as researched in our recently published report, Petrostates of Decline. So I'll touch on the level of dependence petrostates have on oil and gas revenue, the potential shortfall these countries may well face as the energy transition evolves, and then how this makes them vulnerable by combining these two elements, their potential shortfall and dependence. Then we'll touch on financial implications, and I'll hand over to Richard, who will cover for us the key implications for policymakers before we wrap up. So for our report, we looked at the top 40 most oil and gas revenue dependent states that rely on this income to balance fiscal budgets and crucially provide government services. Nearly half derive over 40% of total government revenue from oil and gas. And there are several highly populated, low developed countries which are heavily dependent, including Angola and Nigeria, which you can see towards the top of this chart. So increasing dependence for these countries towards the top of this chart. But first of all, let's see why this revenue is at risk. Now, I probably don't need to labour this point, but clearly the past decade, we've seen costs fall massively for renewable technologies, not least solar and wind. And the medium to long-term outlook for these technologies is one of continued efficiency and declining costs. There have been some hurdles. So inflation recently has hit wind power build-out, but the long-term trend is one of falling costs and efficiency gains. What this means is that for the fossil fuel industry is that it's facing an irreversible decline in demand for oil and gas products, driven by this technology revolution, but also, as we'll touch on later, by accelerated policy action. So in this chart, we've plotted the IEA's STEPS scenario in red and the APS scenario in blue, and we've termed these a slow and a moderate energy transition, respectively, to reflect the pace of demand for declining oil and gas. We use STEPS throughout most of our work to reflect what the fossil fuel industry is largely assuming in terms of future demand and in terms of their investment plans. And you can see this from many of the large companies in various reports. But it is also worth noting that OPEC assume a higher demand than STEPS, even in the long term. But this use of STEPS is quite important in our work because many companies will have projects in their portfolios which they may have no plans to develop because they're too costly. So we don't want to include these in our analysis. We want to reflect as best we can industry expectations. So in some cases, our view on risk or revenue shortfall could be conservative, where companies or countries are planning investment sort of outside of what may be sort of seen compatible with STEPS. So the key takeaway here is that there is a limit to how much future oil and gas will be needed. Lower demand for oil and gas will lead to lower long-term commodity prices, lower revenues for companies, including national oil companies and their host countries. And this will impact all government revenues, regardless of production cost. So before we get into countries, let's first look at how future production from some of the largest national oil companies might be affected in a moderate transition. So this chart shows for each company down the left-hand side, from an economic least cost perspective, the proportion of their future production that might fit within a moderate transition. That's in pink, so that was the APS, compared to unsanctioned production that could fit within the IEA's STEPS. That's in red. So the blue bars represent projects that would fall outside of even STEPS. So some NOCs look quite exposed in terms of unsanctioned production that might fit or be needed. And there are others towards the bottom that appear less at risk, like Saudi Aramco, Sinopec towards the lower end. However, associated lower prices will negatively affect revenues for all petrostates. So the point isn't just one of portfolio diversity or lower production costs. It's about declining commodity price as demand slips away. So let's turn to look at the impact on country revenues, firstly across the board. Expected revenues out to 2040 are hit substantially, All regions here are affected, even those with lower production costs. Looking at our universe of the 40 petrostates that we analysed in this report, and we can see that the majority of these revenue declines are really concentrated within the petrostates, some 8 trillion lost under a moderate transition out to 2040. Now, this isn't to say that other countries shouldn't transition from a fiscal sustainability perspective. All countries absolutely should, not least for future generations. But it's also worth pointing out again that the transition is likely to accelerate with ongoing technological innovation and increasing policy action on climate. So we're just looking at a moderate transition scenario here, but the outcome could be one of a much faster decline in oil and gas demand. So let's look now at which countries would be affected. So in this plot, which we showed in the previous report in 2021, we're looking at our universe of the 40 petrostates and their bubble size by population. And where they plot in terms of their dependence on oil and gas revenue on the horizontal against potential loss of this oil and gas revenue on the vertical axis in a moderate transition compared to a slow transition scenario. So the top right of the chart represents more vulnerable states in the face of declining oil demand because they are highly dependent on revenues from oil and gas. And from our analysis, they are countries whose revenues losses are expected to be quite high under APS. So it's the combination of these two factors, the dependence and the potential revenue loss as prices fall. Several African countries land in our highest tier of vulnerability. So there is clearly the fragility of some of these petrostates highlights the really urgent need for diversification. And core to this is subsidy reform, widening fiscal revenues, and there are examples of countries that have been doing this. With international support, some particularly vulnerable petrostates need access to finance to develop new industries and also help to break the vicious debt cycle. So on debt, not helping matters at all is the general trend of debt rising. Among the petrostates, some of the most vulnerable have high and rising debt levels like Nigeria and Congo. Combined with lower revenues brings lower credit worthiness from the 3 or 4 rating agencies. So both of these factors have implications for investors and could lead to quite serious consequences for sovereign markets. So if we consider all of these factors, lower revenues, worsening debt and credit ratings, it's not hard to see how countries dependent on oil and gas export revenues will see negative impacts to their GDP. So that's along the top here. Reduced consumption, government expenditure would all follow, not least on critical services and declining state investments. So in the bottom here, in stark contrast, for countries not dependent on oil and gas export revenues, or perhaps those that have managed to successfully diversify, they will see a reduction in expensive imports as they have capitalized on competitive advantages in a more superior renewable energy system that is swiftly coming in. So with reduced revenues, increasing debt comes lower credit worthiness and credit rating downgrades. This makes the diversification challenge a lot harder, increasing borrowing costs and also confining their access to wider markets. For investors, these sovereign markets will become more risky and therefore higher yields will likely be expected. And again, increasing borrowing, and there are clear issues around indebted countries actually sustaining their debt. And more broadly, a decline in oil prices could have cascading effects across other financial markets, not least those dependent on the oil sector, impacting everything from credit ratings to equities. I will just hand over to Richard for some points on action for policymakers.
Guy, thanks very much, and good morning, everybody. Thanks very much for joining us, and it's good to see the questions are coming in already. So Guy has taken you through his economic analysis, and one can see how there could be major political policy implications as well for petrostates because of the transition. So I wanted to take you through a few points here relevant, which hopefully is going to give you some food for thought. First, on diversification, And we saw this debate play out at COP28 in Dubai about diversification, about transitioning away from fossil fuels. And, you know, to some extent, this is about self-evident facts relating to the increasingly urgent challenge of climate change. But arguably also it can be seen within the context of energy security. And I'll say a little bit more about that in a bit. And the developing countries will claim with some justification that richer countries, those who can afford to diversify away, can transition first. Morally, they should do so, and also with developing countries being most vulnerable to the impacts of climate change. My second point, and again, this is self-evident, really, that that the challenge of diversification is going to be even more difficult during an economic downturn. And this argues, in our view, for petrostates to get ahead of the game on this in terms of approaching more systematically the challenges of the transition, but also thinking in a more strategic sense about the benefits of the clean energy economy as well. And then moving to that third point, which is linked here, and you know, this point is worth making, that there are many developing countries, least developed countries, who can benefit from these clean energy opportunities. Democratic Republic of Congo being one, South Sudan, they're examples of petrostates that were up on the chart, the grid that Guy showed earlier. They're examples of countries with access to critical minerals. And then also within the context of least developing countries, we're seeing a little bit more talk about possibilities for regional cooperation, South-South, and for example, how Kenya can be an African renewables hub. I mentioned energy security earlier, and I wanted to come back to this and to make the point that we've heard, in particular since the Russian invasion of Ukraine, a lot about energy security returning to the top of the agenda. But what this report, Petrostates, underlines with the fiscal vulnerability of petrostates is that we arguably need a redefinition of energy security in 2024, one which is based more on domestically generated renewable sources, which are not subject to the volatility of commodity prices, commodity markets, and geopolitical weaponizing that we've seen as well, most notably, of course, by Putin. Then the last point I wanted to make here, and within this context of geopolitics, is, I mean, we can all see, sadly, how geopolitics around the world is more on our minds, instability in differing regions, and that an unfolding disorderly energy transition against this backdrop is in no one's interests, especially the petrostates, and no matter what benefits that some governments might see from short-term energy price spikes. So let me stop there. I'm going to hand you back to Guy for the concluding messages. Thank you.
Thank you, Richard. So just to wrap up, as we've seen, due to the substitution effect from renewable energies coming in, the fossil fuel industry is facing a decline. And we've also touched on how the GDP landscape could be completely reshaped by this by the small task of decarbonising the energy system, and how that will impact exporters and importers in very different ways. The lower demand and the impact on oil and gas revenue will impact all exporters, regardless of the cost of production, because it's the hit to revenues and particularly on the impact to long-term cash flows for some of the lower cost producers. Overall, from our analysis, many of the most vulnerable petrostates would lose over 40% of total government revenues versus their expectations. And finally, Reduction in future revenues will likely increase debt and impact creditworthiness, which will have an impact across sovereign markets and debt markets more generally. And I'll just hand back to you, Richard, because it might be worth you taking the international support point.
Yes, thank you, Guy. Yeah, I mean, international support, when that is mentioned, it's often seen what can global north countries do in terms of providing support from public finance. But I mean, what is clear, there is a consensus on this that the lion's share of funding for the transition is going to have to come from the private sector. I mean, forecasts vary about the scale, but if you take a well-researched report from IRENA, the International Renewable Energy Agency, they say that annual investment in clean energy technologies, and I include here not only electrification, renewables, but energy efficiency and grid expansion. IRENA there talked about financing of the order of $5 trillion needed by 2030. And really, if one comes back then to the role of policymakers, governments here, particularly the global north, but thinking about the international community as a whole, their responsibility to help to create enabling conditions for policy which can enable that sort of scale of investment to flow. And just as so we know where we are now. I mean, we're looking at about 1.5 trillion per annum at the moment, which is being provided in terms of clean energy financing. So a major step change required there. And our report, if one is thinking about ideas about the sort of mobilizing public support, which can really then incentivize the private sector to come in. We look a little bit about ideas in the report there. Looking at fossil fuel subsidies as one possibility there of public support, creation of sovereign wealth funds, new taxes on fuel and VAT, and other ideas are emerging as well. For example, can the international carbon market be a big source of revenue for transition funding? So I think, Guy, that's the conclusion of our presentation. So Simon, we're going to hand over to you now in terms of questions. Thank you.
Yeah, great. Thanks very much, both of you. We've got quite a lot of questions coming in, so we're going to crack on pretty quickly. Just a reminder, everybody, if you do submit a question, please don't do it anonymously, because we like to follow up with you if we don't get round to answering the questions live. So really, the first question, which is quite an easy one, and this is really for Guy, and it comes from Randolph, and he says, why isn't Guyana included in the 40 states?
Sure. So we did include Guyana later in our report, but Guyana came in under emerging petrostates because it doesn't yet have the same level of fiscal dependence on oil and gas revenue. So it's probably worth touching on the emerging petrostates more broadly. The risk is different depending on the level of investment they've made, and it's more about losing potential cash flows rather than existing. And I'm sure for many, the prospect of bringing in a major revenue stream, perhaps when not much already exists, may really tempt these countries, these emerging petrostates, to take on the risk is that they take on debt to build up these industries, only to find themselves very quickly overstretched right at the time when oil and gas demand is likely to decline, as the IEA predicts will happen this decade. So public money would be wasted on assets that potentially become stranded when they could have been spent on more resilient industries or transition-ready industries, better equipping countries for the transition and also providing domestic energy needs.
So, can we just quickly whip through a few names for the audience to say, okay, if you're thinking of investing in this sovereign wealth fund, or you're looking at this, this sovereign bond, or you're looking at this particular emerging NOC that's trying to raise debt, which countries would you say are are likely to be the most at the most significant risk, and that for investors might just like to avoid them?
Yeah, I mean, we did touch on emerging petrostates in the report, and the landscape kind of changes quite quickly depending on the prospective assets that are being developed. But we found that Mozambique, Ghana were set to lose a significant proportion of their expected revenues, but also Ghana, Senegal, and Uganda, and some of those appeared in the last analysis that we did as well.
And just bringing Richard in, if you've got an emerging petrostate and you're looking at that from an investment point of view, what sort of policy actions you should be looking for that will tell you whether they are moving towards pursuing a fossil fuel future or moving away? What are they looking out for?
So from an investor point of view here, you're going to be thinking about political and policy risk. And people on the webinar, I'm sure, will be familiar with the resources curse. And so, you know, those who maybe got sort of trapped a little bit in that in the past, which has not been conducive to good government, to political stability, and to economic stability. So what are the sorts of things that we should be looking for in terms of, as you say, Simon, or the question, emerging producer status? I think there is a lot there about government structures, good government. There is something here, I think, about whole of government approach as well. So you know, if we think of certain petrostates, you know, being led by the energy department. I mean, here when I talk about a whole of government approach, talking about the central involvement of those with economics, and also, and I think this comes back to the context of the Petrostates report and the challenges that Guy has outlined. The Ministry of Finance has to be centrally involved as well here, you know, thinking about, you know, economic and financial implications as well. And then I think the final point I would make here, Simon, is again, thinking about sort of potential risks in the future and opportunities around diversification. So again, whole of government approach, which is not only looking at the, well, I suppose the revenue benefits for emerging producer, but also what are the opportunities to relating to clean energy, but also to guard against those risks of becoming too fossil dependent.
Okay, thank you, Richard. Let's move on. Guy, quick question. I think it's a couple of years since you did the last Petrostates report. How has the vulnerability sort of changed since the last report? Are there countries whose vulnerability is accelerating quicker than others, and therefore would perhaps start to see a credit rating decline quicker than you others?
Yeah, I mean, there were some changes. Generally, on the whole, we found that a lot of the petrostates were facing growing risks around debt and downgrades in credit ratings. We didn't get into that in too much detail, but the key point really was, and the concern was that many of the LDCs, the African states, have moved into a higher vulnerability tier. And I'm just spotting another question, which I could perhaps address at the same time, is that this increased vulnerability is due to both an increase in the dependence on oil and gas to balance overall fiscal budgets, so as a proportion of total government revenue, but at the same time, the risk of losing future revenues or the potential revenue shortfall has also increased from our latest modelling analysis. So it's the combination of those two factors. But yeah, the key change on this report was the progression of African states into a higher vulnerability tier.
Okay, so I'd like to switch tack a little bit, because you mentioned, we've talked a little bit about the NOC, sorry, the petrostate vulnerability, but you touched on the NOCs, and NOCs raise a lot of debt in the corporate debt market, and is there a correlation between the state of the the vulnerability of the petrostate and the NOC, or are they kind of separate? Saudi Arabia, might be very vulnerable, but at the end of the day, their NOC might not be. How should investors, corporate debt people, look at the two, combined or separately?
Yeah, I mean, national oil companies, they can, they do issue bonds, and these bonds are generally considered, obviously, corporate bonds, despite the fact that the NOCs are state-owned entities. So I guess the key distinction here is really on the issuer of the bond. So when a national oil company issues a bond, it's the company itself rather than the host government that is responsible for paying that debt back. But there are a few kind of nuances. So credit rating and risk, the creditworthiness of the bond issued by the NOC can be really closely tied to the credit rating of their host country. So maybe there'd be some lag there, but given the relationship between governments and the NOCs, that's an important consideration. And government support as well. So in some instances, bonds issued by NOCs might come with a certain degree of government support or guarantee. So whilst the corporate bonds may be seen as very distinct, I think there's a clear relationship, given those two factors at least, and others, that there is growing risk there if the vulnerability of the host government is very high.
So on slide 10, you looked at the NOCs and their risk to the various scenarios. If you were going to say, well, okay, I'd like to, I'm looking at an NOC, but what I want to do is I want to sort of, do a screening process between, the vulnerability of the petrostate and the vulnerability of the NOC to give me a sort of almost like a total score for this kind of screening. Is it just as simple as ranking the two and then just adding them together, or is there is that a good place to start, or is there a lot more in it?
Sorry, I lost you slightly towards the end there. I think there is a link between the two, but there's probably more. I mean, I think looking at the future for the vulnerability of the petrostate would be quite important, given the ties between the two, and then also the relationship between the NOC and the government. Many of the NOCs are not completely government run. So Petrobras, for example, was about 70%. The shares are actually on the private market. So I think that would probably be one place to start, a distinction between the two. But overall, as we touched on, there would be a spillover effect across all markets, whether you're talking the debt markets or equities.
Now, I want to come back to you, Guy, to chat about the GDP slide that you put together, but first of all, I think to give you a moment to rest, I'd like to ask you, Richard. There was a lot of noise around COP28 being hosted by a petrostate. When we've had time to consider it now, what are the key takeaways that investors should take, or in general people should take from the fact that the COP was hosted by a petrostate? What do we learn from that?
Yes, there certainly was a lot of noise, Simon, and there will probably be more noise in the run-up to COP29, which is going to be hosted by another petrostate, which is Azerbaijan. But really the UAE was, although Qatar had hosted the COP about 10 years previous, but there was of course even more noise with the COP president being also the chairman of ADNOC, the UAE National Oil and Gas Company. What can we take away from this? So most significantly was, for the first time in the text agreed, the declaration on the global stocktake was about the need to transition away from fossil fuels. And that was significant. A lot of climate campaigners were still disappointed. They felt that there should have been more explicit language in there about fossil fuel phase out. But it's the first time that language about transitioning away from fossil fuels was included. And I think that does send an important signal internationally. But the other key point I would make, and this was, I'd always believed that it was actually helpful that a country like the UAE was hosting the COP, because that really did help to focus attention on the source of climate change and the climate crisis being fossil fuels, and that so that really was that whole sort of lightning rod for the debate around this, and this is fundamental, is that solutions, agreements that are going to be reached internationally here, in my view, has got to involve all the parties. And actually, I think that the UAE government broadly played a constructive role. There were some misgivings. Some people had, oh well, they're going to be supporting too much in terms of fossil fuel interests, but in fact, I think the UAE did a reasonable job in trying to reflect, overall view amongst the parties. So there you are, two concluding points on this. One, the signal sent about the language transitioning away from fossil fuels, but also having all parties in the room to try to come to an accommodation around this.
Okay, thanks, Richard. Guy, you've got the slide up there. We've talked a lot about the effect on GDP of the petrostates, but essentially, for the last goodness knows how long, because oil, gas, and coal are largely traded globally, the price of energy has, because it's traded globally, acts as a levelizer in the cost of energy from country to country. But a decarbonized system, where we electrify a lot more, will break that down. We will get much more of a comparative advantage from country to country on the price of their energy, dependent on the mixture of the decarbonized energy systems. Now, for example, a country that relies solely on, for example, nuclear power to get a decarbonized energy is going to be way more expensive than a country that, for example, relies 100% on solar. So can you talk us a little bit through the effect of GDP on those countries that go from importing energy to creating their own, and in some cases much cheaper than everywhere else, and which will attract private investment?
Yeah, I mean, I think you kind of answered your own question there, Simon. It's the prospects for many countries which are perhaps more vulnerable to the volatility in oil and gas. It really flips things, not least the solar potential for Africa. So just again, looking at this top example, for a major exporter to lose that critical source of revenue will impact across the board these different components of GDP, bringing their GDP down. And in contrast, a country which has been so reliant on imports and really suffered from volatile commodity prices, suddenly is able to reduce this and realize their comparative advantage, and whatever it may be. And if you're looking at Africa, then obviously solar is a huge potential, or offshore Brazil with wind. Suddenly you flip that on its head. The cost of imports and that volatility can reduce, and that inherently more democratic energy system comes into play, and can boost all of these other components of GDP, bringing GDP up. So I think looking through this lens through GDP can really kind of illustrate why the implications for sovereign markets and more broad debt markets more broadly is so significant. I think it's a really interesting question, and one that investors should be really considering.
So we've talked a lot about oil, but many of the petrostates produce gas, and gas is often seen as a transition fuel. And newspaper headlines are full of the growth of LNG, etc., is going to rescue everybody. Would we see gas producers at less risk, or how do investors assess when a country produces both oil and gas, how vulnerable they are? And if they've got lots of gas, does that mean that they're perhaps less vulnerable?
Yeah, I think it's easy to see why there is maybe less vulnerability there in the short term, because of particularly around the narrative of gas as as a bridge fuel. But the risk there still very much remains. Many of the uses for gas, there's still a huge substitution risk for many of the uses of gas. And then related, there's increasing pressure. We talked a bit about policy action. Rich, you're welcome to jump in on this, but I think there's been quite a lot on methane recently. So I think that is probably going to be short-lived. And many credible demand scenarios, peak gas is coming further forward. So I don't think so. I think the risks still are equal across both. In many cases, gas production is very much tied to liquids anyway. So I think no is the short answer.
Yeah, Guy, thank you. Yeah, Simon, if I could come in on that, and I would very much endorse Guy's comments about the overall risks of the transition applying just as much to gas or gas producers as to oil producers. I mean, a few years ago, you're right. There was a lot more talk then about gas being a transition fuel. The IEA would talk about that. They talk about that less now. But also, if we look at it for, and it's Guy's point about comparing the short term with the long term. So after Russia's invasion of Ukraine, widespread concern there about, right, where's Europe going to get its gas from? And what this would do for the LNG market. And we saw short term, right, US, we're seeing Qatar as well. There was some irony, I think, that the German government going to Senegal to an emerging market producer, maybe to be able to help in terms of gas imports. But also, I think, again, a recognition that there might be short-term benefits here, but there's significant risks in the longer term, whether it's relating to stranded assets around infrastructure relating to gas, but also coming back to this point about overriding dependence on gas as an energy support source, and for that to be seen in terms of energy security, as well as the transition.
Okay, I've got a couple of we've got a couple more minutes. I just want to throw a couple of questions to you both, if I may. We've talked about the loss of revenue and mitigation. Where do sovereign wealth funds fit into this? Should an investor be more confident or less worried about this risk of petrostates from the reducing demand of fossil fuels, if they've got a great big sovereign wealth fund? How do they bring the sovereign wealth fund element into their investment process? Guy, what do you think?
Yeah, I think we didn't look at sovereign wealth funds in too much detail in this report, but encourage readers to have a look at Beyond Petrostates, where that was looked at in more detail. And there are a few facts and figures in there about how long a sovereign wealth fund would actually last in the face of sufficiently significantly declined demand for oil and gas, and the answer is not very long. So I think kind of it reduces really quickly if you were to price from oil down from say $40 to $20. So I think the term used was is not a get out of jail free card. But one thing that sovereign wealth funds can offer is the opportunity to diversify. And that's really important, particularly when revenues are high. Now is the time to invest in whether it's broadening the fiscal base, whether it's reducing subsidies, or trying to kickstart other industries. So sovereign wealth funds can support that, and countries should be investing in sovereign wealth funds. And we give a few examples in the report. But yeah.
No, sorry, Guy, go on. No, I just wanted to add one point.
Yeah, I mean, I think in terms of vulnerability, for sure, sovereign wealth funds will offer some assurance there for investors.
And to add, I think good governance is important, clearly, around sovereign wealth funds. And going back to that point I was making earlier, for some countries maybe the resources curse, but also here to Guy's point about diversification and what we were saying earlier about the opportunities in critical minerals, and will there be there for developing countries, including petrostates, to generate significant revenues from this new clean energy economy, and opportunities there to set up sovereign wealth funds which can really act as a sort of bulwark for economic stability and against economic risk. I mean, one of my views is that this new energy economy is going to have to require a lot of innovating fiscal and economic thinking, and maybe part of that is going to be sovereign wealth funds relating to critical minerals.
Okay, thanks, Richard. And one last question before we wrap up, and it's a tricky one. Guy, when you look at petrostates, is there a petrostate that's doing the right thing, where investors can go and have a look and say, okay, these people are getting it right, and that could be a roadmap for what they should look for in the other ones? And is there an emerging petrostate, or not an emerging petrostate, that's also doing things right, where investors can go and say, that's a template for what I should be looking for elsewhere?
Yeah, probably by design. I mean, I don't have the answer for emerging petrostate, but there is a success story in Dubai, one of the Emirates, who have successfully not a petrostate in its entirety, but they have managed to reduce their oil and gas revenue dependence massively via some of the diversification topics we've talked on, developing other industries, broadening fiscal base, etc. So that's probably see, we're running out of time, but that's probably a good case.
Okay, thank you very much. A couple of thank yous to Evgenia, who works tirelessly behind the scenes, and this is in fact probably her last webinar, because she's got an exciting new adventure coming up. To you, Guy, to you, Richard, and thank you very much for the presentation, and of course to the audience who spend their precious time with us. And before you go, a couple of things coming up on Wednesday the 20th. we launch our oil and gas alignment note, but also we have a webinar launching our oil and gas profiles. Now, these profiles are designed to help investment teams and engagement teams incorporate a sustainable screening process to run alongside your normal valuation screening, to pick those companies that on the one hand look great value, but on the other hand are insulating themselves against the demand destruction that is happening as the new decarbonised system increasingly comes into play. And watch out for our CCUS new note. The working title is Curb Your Enthusiasm, and that's much more focused on the business model. We're moving away from, technology is the problem. If you look at actually the technology is largely proven to a certain degree, but we're looking at the business case, the funding case, and how choosing CCS perhaps will put you and your country at a competitive disadvantage compared to other sources of decarbonised energy. But anyway, thank you very much for joining us. Do look out for those, and we look forward to seeing you again. Bye-bye.